Say I'm good, but I got my whole household is sicker than dogs right
Oh
now.
man, do you want to reschedule this?
No, I woke up this morning ready to go.
Okay.
Hacked out some green stuff and rip roaring and ready to go.
Well, I mean, it's fine. It's totally up to you. If we need to, I completely understand. I'm looking forward to having the conversation again. So,
No, yeah, I'm sorry. So just so we know, like right now, listen, I got my wired headphones and I got everything. So I got my cute little microphone and
oh,
everything.
nice.
Um,
I've seen that model before, brand before.
yeah, I have some friends that run a Atlanta United podcast out of Atlanta. It's
Yeah,
a soccer club, and he's like, "Man, if you're gonna start, this is the one you got to go with right here." So,
very cool.
all right, let's do it.
Well, this is the second go round, right? So, which I kind of appreciate because, well, let me back up for a minute. The last time was my fault. I heard that little ticking sound and I was like, you know what? I should be able to clean that up with my editing software.
Hmm.
And I played around with that thing a lot longer than it would take us to re-record or to have this conversation. I was like, and it still sounded like crap. I was like, I got to see if Anthony can do it again. So,
Yeah,
uh,
yeah,
but man, so I appreciate you being willing to do it again. But I will say that since you and I talked, because it's been several weeks,
yeah.
I've had the chance to interview a couple of folks, Holly Morphew, who is a financial coach, and Danny Randazzo, who is an investor syndicator. And off air, I asked them, "Hey, are y'all familiar with this infinite banking strategy?" And as soon as I said it, their faces lit up. Right? They're like, "Yes." I was like, "Why didn't I ask you that when we were recording?" Because I
Yeah.
wanted to get their info about it. Or maybe I did with Holly, but with Danny I didn't, and then I didn't record it. But they were super excited about it. So last time you and I talked, I I think I left that conversation. I think I even made the comment I left this conversation more confused than when we started it. But it wasn't. And what I'm trying to wrap my head around is where that money just magically appears, right?
Right,
And I
right.
want to understand everything before I dive into that sort of investment strategy. So
Absolutely.
hopefully today we'll clear that up even more for me.
Yeah. I'll stay away from because I've got those videos out there on the internet and everything.
Yeah,
Stay away from talking real hard numbers and really talk very conceptually, like
I
how
like it.
who's the money, where's the money coming from, how's it changing hands, and all that good stuff.
Yeah,
So
and we can make links to the videos
yeah.
for people
Hey,
to reference.
what software do you use to edit your podcast?
Audacity.
Audacity, perfect.
Yeah, yeah,
Because I'm
it's free.
launching mine in about a month or two. So
Okay, cool.
just pooling all the analytics and all the stuff that I need. So
Yeah,
yeah,
Audacity's it's very I'm hitting the tip of the iceberg on what it can do, but
yeah,
it's a really good piece of software and it's free, so
yeah.
it's kind of hard to beat. But anyway,
I hear you. I hear you.
all right, man. So let's dive into this. So we're
Let's go.
talking about infinite banking strategy, right?
Yep.
Which is a concept created by, is it Nelson Nash? Is that who
Nelson
created it?
Nash. Yeah.
Did he
Hmm.
create it? I know he wrote a book on it, but
Well, let's say this. He certainly put the name to it, and he certainly started using it.
okay,
I think inadvertently people had been doing it in the past, but Nelson Nash, he was the one who said you can do this, and
yeah,
so he is, I would say, the creator of its so-called implementation.
okay.
It's not like these products didn't exist before Nelson Nash, but he was the one who started using it.
He put the spotlight on it, right? He
Yeah.
started using it and put the spotlight on it, which I think is cool because I asked Holly, who's a financial coach, if she recommends the infinite banking strategy for her clients, and she said, "Well, I am." She goes, "But I'm one of those coaches that I'm going to go through it first,
Yeah.
get comfortable with it before I recommend it." And I was like, "I totally get that, totally understand it." So
Yeah.
she's in the process. I didn't get actually find out what the process she's in and doing it, but it takes
Right.
time to build up, right? So I mean,
Yeah. Yeah.
so basically this is a whole life insurance policy.
So yeah,
Get into
there's
get it. I'm going to
yeah,
butcher that,
okay.
man. So let me turn it
That's
over
all
to
right.
the
That's
expert
all right.
here.
Um, there's lots of facets of what dry planning, the firm I work with, does, but I would say this
Yep.
is easily one of my favorite things to do for people. And I mean, for real estate investors, it makes a whole bunch of sense. But so the infinite banking concept in its purest form, I should just say the concept in its purest form, is structuring a certain permanent life insurance policy a certain way with a certain insurance company.
Okay.
So all those certains involved in there. So
Yeah.
banking, bank on yourself, better banking. We call it the private reserve strategy. Cash flow banking has also been called. So Nelson Nash's original methodology was a whole life, dividend paying whole life policy structured a certain way with a mutual insurance company.
Okay.
So it has to have all three of those things.
Okay.
And the reason it has to have all those things is, one, the mutual insurance company is owned by the policyholders. So that's a big difference. So you can have a stock or a shareholder insurance company, which kind of defeats the whole purpose of this whole thing,
Yeah.
because somebody else determines how much money comes in. With a mutual insurance company, the dividends are tied to the performance of the company, and it's a privately held company. And we will probably get into some of the advantages of going into a privately held company, but so it's a whole life policy. And again, I use the word permanent life insurance because there's term, and then there's different
Right.
kind of terms. There's 10, 15, 20, 25, 30-year term. Um, and then there's permanent insurance. So in permanent insurance, you have whole life, variable life, universal life, index universal life. And then every insurance company out there has their own products based around all those four umbrellas. So not all insurance companies, not all insurance products, and not all insurance agents are created equal when it comes to setting these up for specific goals, because
Okay.
real estate versus someone who's using it as a retirement fund versus someone who's trying to leverage it out for real estate, it's a night and day structure. So
Okay. So let's get into that a little bit.
yeah.
The mutual insurance company, I want to make sure I
Mm-hmm.
understand this. So not all insurance companies who provide life insurance are considered mutual insurance companies, correct?
That is correct.
So how do I know if I'm out shopping around, I'm going to look at Drive Planning? I've got actually a couple more. Those folks I mentioned earlier, they referenced
Yeah.
me to who they were using.
Mm-hmm.
How do I discern that just from me being
Sure.
very new to this concept and making sure I'm
Yeah.
not getting taken advantage of? Even if if I just go out and Google infinite banking strategy or Nelson
Right.
Nash banking or whatever, or become your own bank, which I want to
Yeah.
understand that a little bit better, because that's where the magic happens, right? It's where the money just magically appears, and that's what I'm almost like, man, this is way too good to be true. And you know what they say about it. So, but back to my original question, the biggest thing is, how do you know the insurance company is a mutual insurance company that fits all those check boxes that you want to be able to get into this type of policy?
Yeah, of course. So kind of a two-part response to that. I would say definitely find somebody who is a specialist in this kind of stuff, in
Like
this
yourself.
actual strategy, kind of like ourselves. So Drive
Okay.
Planning, we're not an insurance company. We're a
Okay.
financial consulting firm. So
Okay.
we do much more than this. This is just one big component that we can show people how to do. So we go through, I would say two, well, mainly just one company, but you can Google
Okay.
mutual insurance company, mutually owned insurance companies, and that should bring you up a list. And specifically, you can probably Google which mutual insurance company has, and so some of our criteria, they've paid out dividends for at least 100 years. So
Okay.
for the past 100 years, they have paid dividends. That's a big thing because not all insurance companies have. So going back pre-Great Depression, through the Great Depression, through the Great Recession, have they paid out dividends? It's big, even if it's been 3%. I mean, if you made 3% from 2008 to 2010, you'd probably be the richest person you know.
Yeah, you're doing all right, right?
So,
You're doing better than the rest of us.
it comes down to track record with them. So you can
Okay.
find a list of all mutually owned insurance companies.
Okay.
But do they change their rates? So we use the indexed universal life insurance policy, and we can talk about why we use that versus whole
Let's
life.
don't get too technical, man. Let's keep it
It's got the downside protection, but you can kind of feel some of the, when the market does well, you can feel the good upside of it too. That's why we use that. But have they paid dividends for at least 100 years? That's the thing. Do they change their rates? Do they always, every year, they're changing their dividends? This year it's 6%. This year it's 2%. This year it's 3%. I don't like volatility. I like consistency, and
Right.
You want consistent, uninterrupted growth, and you're going to get that. But when you can predict, I know I'm getting 5%, 5%, 5%, 5%, 5%. That's when the real, like, you can rely on it. You can bank on that to be
And
punny this morning. So,
yeah, and you're yeah, that's money in the bank, right?
yeah.
You just so we're clear, we're talking about just the return on the insurance policy itself. We're not really into the, hey, if you take the money out and invest it into real estate, that return, right?
Yeah.
You're talking
Yeah, I'm talking about just the internal growth.
okay.
So,
Or
and I guess
okay.
this is a good time to talk about that. So, let's put it in terms for the real estate investor. I mean, that's the vast majority of your audience, right?
Yes.
Um,
Hopefully
if
100%.
yeah, right. Yeah. Um, if you buy a house for, let's
Right.
just say buy and hold
Stick to
purposes,
easy math for me, man. Stick
we're
easy
not doing any money here.
math.
So you have two kind of factors. You have the appreciation, and then you have the equity in the home.
Right.
So the appreciation is something that's never really actualized until you sell the house, right? You know it's there, and you're hoping that it's continuing to go up, but you never really feel the benefit of the appreciation until the sell of the house. You can think from an insurance standpoint, that's the death benefit. Jay Helms, as the insured, don't really feel the benefit of that. Well, never, because it's
Right.
when you're called on home.
Yeah, not directly, but I do have the comfort that my family's going to be taken care of for a little bit longer. Right.
Vitally important. I mean, if you have outstanding mortgages on your properties, I mean, that is kind of your get out of jail free card, where you don't leave your family with a bunch of mortgages that's all
Right.
covered and they own the properties outright. But
Yep.
absolutely. And thank you for saying that, because that is a very overlooked portion of it.
Yeah. Yeah.
So
Benefit to me is that
you
I
get the
don't worry as much.
yeah, exactly. You get the peace of mind, but you never really see that money.
I also don't want him to throw a real big, huge party. He's gone.
Yeah, woo, let's do it. And so that's why I love permanent insurance, because you
Yeah.
have a second arm to it. And
Okay.
this is where a lot of people don't understand. So you have the death benefit, which is separate, and you have what's called cash value inside of the policy. And so if you've done numbers on this, term insurance cost is very small.
Yep.
Permanent insurance cost is much greater. But it's that overpayment. So if term costs this much, it's that overpayment that goes into your cash value accumulation over time.
Gotcha.
And so you can think of that as your equity. Now, the biggest difference is the equity in the policy is you can get up to 90% of it, and it's liquid. I mean, it's a phone call, email, and you have the money wired to you. There's no negotiation. No one has to do an appraisal on your policy or anything. So
there's no health check that you have to go through, right?
That is correct. Yeah. So that money, you can think of that money as yours.
Okay.
Now, let's say 5 years down the line, you just stop paying for the policy and it lapses. You get the cash value back.
Okay.
That's because it's your money. You get whatever cash value you have built up, you get that back, and they can't legally keep that from you. So that's another thing that a lot of people don't really understand or overlook. So the cash value and the death benefit are two separate amounts. Okay. So appreciation versus equity. If you can think about equity you can use, and the cash value is your equity.
Cash value. I want to write this down. Cash value and the death benefit are two different.
They're two separate things. Yep.
Two separate things. That's I've never thought about that. That's interesting. Because I always thought they were the same.
So Jay, you know, like, I'm big on the human capital piece and having
Yep.
people around you that are good at what they do. And that's why I would, if anybody's listening to this, do not go online and try to get this yourself. Work with somebody that you know and trust. Vet 40 people if you have to. Do your due diligence, but make sure that you're involved. Just like a CPA. If you're a real estate investor, you need to work with a CPA that knows real estate. Holy smokes.
Well, yeah, and I'm smiling and I chuckle because this year was the second year that I've actually used a CPA.
Yeah. Talking about it kind of lowers your stress level, you know?
Oh, dude, it is amazing. You know, and it's not that I didn't want a CPA. It was the control factor. It was just like, okay, I can do this myself.
Yeah.
Get a bottle of liquor, take a weekend, you know, and just knock it out. And I can do it. I don't need to pay somebody whatever the money is, you know, whatever the cost may be. This year was like $1,000 because of some stuff we had going on. And I was like, you know, but I was extremely happy to pay that $1,000 because literally I collected all of my things. And I asked them when I took them up, hey, do y'all prefer to just like get all these things in this brown paper bag I'm bringing you, or is this
Sketchy
how you?
transaction.
Yeah, no, I mean, it's just, no, it was all legit, all legitimate forms, but it was just one of those things where I feel like I'm just dumping on them, like,
Yeah.
it is what it is. And they were happy to do with it. And I'll say this. So this year, and I know that the tax laws change, but
Mhm.
this year this is the second year we've used them. This year we paid the least amount of taxes we've ever paid, and it was half as much as last year.
Hey, all right.
So I'm happy
Yeah.
um, to use a CPA from now on.
Yeah.
I mean, they definitely have our best. I mean, they definitely earn every penny because of how I
Sure.
give it to them.
Yeah.
But
I'm
it's
sure it's better than most, although from what I've heard, I'm sure it's better than most.
yeah. So yeah, I would agree. And this is something where you talk about you got to vet. I've got to really vet. What is
Yeah.
this? Because the last thing and there's something else I was going to ask you is, when you put your money into a bank, it's usually backed by FDIC, right? So if
Yeah.
the bank gets robbed or something happens,
Hmm.
your money is still there, even though that cash may not be there.
Sure.
So is there something like an FDIC in this type of insurance policy that guarantees, okay, even though I've Googled, even though I've vetted out and done these things, like you said, you guys only work, which I assume the way you explained it earlier, kind of like a broker for some of these mutual insurance companies. And, what happens if something happens to that mutual insurance company, right? Is
100%.
there a guarantee that, the famous line from Tommy Boy, I can shit in the box and market guarantee, but what do you have? You
Yeah.
know?
Yeah.
So anytime I say the word guarantee, that quote comes to mind because a couple of friends and I just kind of dove into that and just used it way more than we should have. And I'm getting off on a tangent here, and I'm not calling your product poop for any reason, but I want to make sure that when I do this or when somebody else does this, that we have all the necessary boxes checked off. Like, how do we know that we just didn't hit something that paid the right amount of Google, marketing, advertising, whatever, and
Right.
hit number one on the screen, click it. They've got a great page. Hey, I'm just going to sign up, and then 2 years down the road, my money's gone.
Right.
How do I make sure I'm not doing that?
Yeah, of course. So there's a lot there. There's so many little things I want to
Yeah.
talk about there.
Sorry.
But yes, so every insurance to be a legitimate insurance company, you have to pay into as the insurance company. Uh, they have to pay into a common bank, a lot like the FDIC. So the name escapes me right now, but there is a FDIC that regulates
Okay.
insurance. So if
Okay.
the company goes belly up, other insurance companies can buy those existing like books of business
Okay.
and like you
Those
are now
assets,
covered under
really.
this person.
Okay.
If all the insurance companies implode, there's this big tank of money that's going to keep things in force
Okay.
and paying stuff out. So yes, there's that. But
So
uh,
ensure that your insurance company is insured.
yeah, yes. Yeah. 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 And again,
Okay.
if the agent you're working with doesn't know this, you'd say, "Hey, thank you for your time.
Yeah, it's a
Bye."
quick conversation, right?
That's what it comes down to. I mean, you think about different companies that have other assets too.
Right.
During the big crash, the Great Recession, AIG, their investment the arm, the banking arm, just destroyed. Their insurance harm didn't continued, wasn't even affected. So I mean, term insurance is actually more advantageous for the insurance company.
Yeah.
98% of term policies never pay out the death benefit because by the time people get older, oh, I've got enough money, I've got enough assets, I'm just going to stop paying for this because I don't need it. Because it gets
Wow.
term insurance gets extraordinarily expensive 20 years down the line. Extraordinarily expensive.
And why is that? Just because they know that event's going to happen pretty soon? The death
Yeah,
event's going
so
to
it
happen?
is an insurance product. And so when you talk about getting signed up for this or getting started with this, age, gender, health history, parents' health history can all kind of run into it. If you're a tobacco user, those things it's going to raise the cost of the insurance itself.
Right.
But if you like as a 28-year-old, it's pretty cheap. I mean, I've got some on my 2.5-year-old and my 0-year-old.
Yeah.
Theirs is, I mean, dang, theirs is ridiculously cheap.
Yeah.
And we'll get into some uses outside of real estate, and that's one of them I want to talk about. But
So
um,
you
go
just
ahead.
touched on something there that I didn't really think about, or I've never really thought about. You can take a whole life, infinite banking, mutual insurance policy out on your children.
I would highly encourage you to do it.
I did not. That may be where I start.
Yeah, honestly. So, I mean,
And then I personally can take a loan from it, or is it?
so there is the insured and then there's the owner. So
Okay.
a lot of times for like buy sell agreements with businesses. So if you have a real estate business or you have some deals with the same person, highly encourage this as a maneuver for you as well, because you can have this tank in your business, which is I mean, talk about tax advantages. It's tax write off because it's a business expense. The money grows tax free and it can be leveraged out tax free. I mean, it's
Yeah.
masterful. But you
Just
can get it on
tax
your
free is
business
amazing.
partners. Yeah,
Okay.
it's the only place you can get tax-free growth in the privately held company. Most
Okay.
tax-free growth is tied to some qualified plan, which is Wall Street or the federal government, in a bank or a CD or a municipal bond. Um, but uh, but this is the only place that you're going to get tax-free growth in a privately held company. And again, when structured correctly, sometimes there's
Yeah. Well,
well,
let's
oh
just say that we can put that disclaimer for everything that goes
no,
around.
100. This conversation is a disclaimer on the background. Please do your due diligence and know who you're working with.
Yeah.
But another thing too that you said earlier, it's like inside the Tommy Boy quote, you said product,
Yeah.
product, and
Yeah.
that's another thing that I encourage people. Don't look at this like another piece of property. Don't look at this as a stock portfolio. In fact, if you're looking at yourself in all of these linear examples, like here's my real estate, here's my 401k, here is my insurance. Not to say that you're doing it bad, because I'm glad you have all those things, but if they're not coordinated and they're not working together, you're missing out on a huge thing. So
Yeah.
people get really product focused when they start talking about insurance. But if you can use your insurance to collaborate with your real estate, if it can be an integrated strategy, all the products are intermingled. Oh, that's when the real power comes in.
So let's talk about that. Let's dive into that a little bit.
Yeah,
And so, and let's use easy math to help me
yeah,
out, right?
sure, sure.
So well, let me back up real quick. So is there a minimum to get started in the infinite banking strategy? I can't remember. Here's the funny thing. So when we recorded this last time, I was
Yeah,
so confident about my brand new editing skills. I threw away my notes as soon as I was like, you know what? I've got to go back and listen to this anyway to clean it up. I'm going to toss my notes. I'm going to make them as I go, because there were some couple of points that I didn't hear. And then when I got into it, I was like, I shouldn't have thrown them away, because they would have made today a lot easier. But let's talk about the minimums, if there are any, and
sure.
how, so let's just say, do I have to have take out $100,000, life insurance policy, or 2 million, whatever the
You're
case
right.
may be? And here's where I'm going to turn it over to you to
Yeah,
explain.
yeah,
What are the minimums? And then we talked about, usually anytime I've gone through health, getting a new policy, there's been some health screening
yeah.
that is required. Is that also required of your kids? If you use your kids if you start insuring your kids, do they have to have a health screening, that sort of thing? So talk to us a little bit about those two different things.
Sure. So as far as, let's start with the minimums and the maximums and all that good stuff. So
Okay.
again, big disclaimer, going
I
back
should have
to
asked what's the maximum, because that's what
right.
I'm going to
Yeah,
hit the maximums.
sure, sure. So the
Yeah.
insurance company within reason will give you as much death benefit as you want, but
Gotcha.
the fact is it's got to come back to goals. If it is strictly protection for your family in case you're gone, the death benefit should be the number one thing on your list. But if the cash value accumulation is more important to you, there's certain companies that offer certain products that allow for higher rates of cash value accumulation and earlier access to it with less death benefit. So that's when you go into finding out what someone wants this actually for. Is, you may not need a 2 million, 5 million, $6 million life insurance policy to get the
Yeah.
cash value that you want to. Because again, it comes back to your age. It comes back to, how much money are you going to use to get into this? But here's the minimums and the maximums. There is going to be a minimum payment because it is an insurance product. To keep that insurance product alive, the insurance company sets the minimum. Now the
Okay.
government actually sets the maximum. Because back in the day, really rich people were buying, $100,000 policies and then dumping a few $1 million in there and having it grow tax free and then taking it out tax free. And the
Because they're
government's like,
smart.
I don't like that. So the government, so there is a minimum.
Government, yeah, they said, wait a minute, we're not getting as big a piece of a pie here.
Yeah,
Let's rewrite the laws
exactly. And so
and steal some more.
there
Anyway.
is a range. There is
Okay.
there is an absolute range that you have to operate in. But again, it goes back to, listen, what is my plan? Do I want this? Do I want X amount of dollars in 3 years? Do I want X
Okay.
amount of dollars in 10 years? And then again, if you're working with somebody who knows what they're doing, there's a way to, again, this is a little detail oriented, but
Yeah.
if let's say you're a flipper and you flip a house and you make this huge chunk of money and you're like, man, this is what I'm going to use to start. But I want to put all of this, let's call it $25,000. I want to put all of it in the account. Well, you can start with a large death benefit, fund it maximally as much as you can up to the ceiling, right?
Yep.
Then over time, as that grows, you slowly decrease the death benefit, which
Okay.
lowers the underlying cost, which allows your cash value to accumulate. And again, that's when working with somebody who knows what you're trying to go after
Yeah.
comes into play. So, um,
That's interesting.
so
Now things are
health
starting to make
screenings.
sense a little
Yeah,
bit. Okay.
yeah, there you
So,
go. So as far as the health screening goes, so if this is the first time, if you are 18 or older, it's the first time you've ever had life insurance, there is an exam. Depending on how you answer the questions, like, hey, I'm a smoker, my dad died of lung cancer, my skin's yellow.
yeah.
They're going to do more in-depth medical exam, but typically it's going to be a urine analysis and blood draw,
Yeah.
and just general height, weight screening.
From
But for
from the comfort of your home, right? Or do you have to go?
exactly, the
Okay.
comfort of your home. Yep.
Yeah.
There's a third party. It's not with the insurance company.
Yeah.
Again, legally they have to have a
Yeah.
third party vendor do it.
Yeah.
But
So
for
I'm
kids,
curious.
they don't need it.
Okay. Your kids do not need it, is what
No,
you just
they
said,
don't.
because
They
I
don't
talked
need
over you. Okay. So I'm curious. So when I got my first, I don't have a whole life insurance policy currently. And I did when I was 21, I started it. Not married, no kids, put $100 a month into it.
Yeah.
And by the time I was 31, I had stumbled upon Dave Ramsey, who's totally against it. And so I sold that policy, actually paid off some debt, and I think last time we talked, I mentioned that we've been debt free for 5+ years, and other than our mortgages on our property. So that's pretty awesome to not feel that pressure of that. But I was not aware of the infinite banking strategy then, nor was I interested in real estate. The things you learn, right? And I forgot where I was going with that. Completely just lost my train of thought.
That's all right. That's all right.
It comes with age, I hear.
Yeah. Age is the mindset, but your body has different plans.
Oh, I know what it was. It was a dumb question. So when that first policy that I had, one of the questions on the questionnaire was, have you not ever, but it was something around smoking marijuana, right?
Mm-hmm.
And lots changed in the last 15, 20 years around that subject. So how do y'all handle that now? Or, with folks in Colorado and all the different states, I think even Florida's passed some laws recently to make it a little bit more easier to have recreationally or whatnot. But how do y'all handle that now? Is that an issue?
So I think it comes back to how you take it in. Well, one, it's your state, obviously. So our firm's based out of Atlanta, where Georgia, it's still illegal. You can have it medically, but there's nowhere to buy it in Georgia. So
gotcha.
You can't.
You have to come to Florida, right?
Yeah, exactly. So if you are smoking it, obviously smoking it, depending on how you're ingesting the marijuana, if you're medically cleared for it and a doctor prescribes it, you have to annotate that on your medicine, like doctor prescribed such and such tincture. I don't know the industry very well, so
yeah, I don't
3 drops on my tongue daily or whatever, so you have to make a note of it because it is a medical prescription.
Gotcha.
But again, the smoking it aspect, smoking it is much more regulated than like creams and oils and stuff like that. So I think smoking it is treated similar to that of tobacco. However, marijuana doesn't have the research on the long-term effects on, let's say, lung disease and cancer and stuff like that. So it's noted, but as long as the state you live in allows it legally, and you have it legally. It's taken into consideration, but it's not something that is a deal breaker for you.
So you're not disqualified if you
No.
check all the legal boxes around that topic.
Sure.
Okay.
And another thing too, and it's actually somebody from the Facebook group I was talking to about it. She's a skydiver, and she asked the question like, "Does that disqualify you?"
Wow. Yeah.
So insurance companies want you to be insured. Like, they
Yeah.
want you to be part of their team.
Yeah.
So, like for military, for example,
Yeah.
I'm a military spouse, like we talked about last time. There's what's called SGLI, and it's the only insurance policy that will pay out if you pass away from military-related death.
Okay.
So in combat, basically, if you die, if you have regular life insurance and you go overseas and you give your life serving the country, the death benefit doesn't get paid out to your family. So the cash value is separate. You get the cash value.
That is
It's just like,
that's
are you a firefighter, or do you handle tigers?
yeah.
Are you a skydiver? It's unnecessary risk on their part, and so they won't necessarily cover it. But they have what's called exclusion riders, so they'll still insure you, and they know that their inherent risk is now taken care of. They're not going to cover any of that, so the cost is just the same as if you weren't one of those things.
That's fucked up.
It's not great. It's certainly not great, but
I mean, it's
from a
you
business
know,
standpoint, I get it, but that's why the
right,
SGLI
from a
exists.
from a business standpoint, I understand they're trying to be profitable, but to not insure, to have our men and women who are defending our freedom and ensuring our freedom, to not insure them on a normal policy, that's I didn't know that.
So
That's messed up. But
just
anyway,
combat related. They'll
yeah,
they'll do everything else.
anything stateside,
You're
you're fine.
training in your Humvee and the Humvee flips, that's covered because that's
Yeah,
not war
I
zone.
gotcha.
That's why SGLI exists,
Yeah,
um, to make sure the families are taken care of.
I
But
gotcha.
even then, like that policy, it's cheap, but there's not a whole lot of coverage available. So
Yeah, and
I wish that would change too. But
that's horrible.
so another thing too, we talked about having older policies.
Okay.
So if someone like you that had cash value built up in the life insurance policy and they didn't get their cash value, it's time to go knock on the door and go get
Yeah.
your money because it is yours. But
Now,
if you have a policy, and let's say, like I know that if I go to collateralize a loan, and let's talk about that next.
okay.
If I go to loan that money out of that policy, does the account draw down? And if the answer to that is yes, you can do similar to a 1031 exchange. I think it's called a 1035, where you can take the cash value and use it to fund the new policy. So if you got one when you were really young, but you have all this extra capital that you want to pour into this thing, and you can get a new policy, you can have 10 policies on yourself. Like it doesn't matter how many policies you have.
Okay. I didn't know that either.
Yeah, you can. I mean, this thing, it goes deep and wide with this with this whole system, but you can use old policies to fund new policies, and that one takes the burden of paying it, and two
Yeah.
also allows you to kind of open up the box to pour more
All right.
capital.
So you just had a couple of questions pop in my head based on a comment. Can I use a term? Probably not, just based on, but I want to make sure I'm clear. Can I use a term insurance policy to start a infinite banking mutual insurance policy? I'm assuming the answer is no.
Technically, yes.
Oh, I can. Okay.
If you stay with the same company, and the agent was smart and made it convertible, and that's typically, I can't imagine they wouldn't have. If you have an existing term policy, there is a convertibility stipulation rider, addendum, whatever it is, and it just means at any point in time you can convert this to a permanent insurance. Now it's going to be at your attained age. So if you got the term when you were 20, and now you're 40, it's going to be the cost of a 40-year-old's permanent policy.
Makes sense.
However, if it stays within the company, let's say you're with National Life Group, for example, or Pacific Life, those are two of the best when it comes to the products that we use. You get credit. So if you've had it for 20 years and you're converting it in like year 19, or year 20, because it's about to expire, and you convert it, they will give you what's called term credit. And that'll typically start your funding process off right, at least for 1, maybe even 2 years, depending on how long you've had it. So yes, the answer is yes.
Okay. Is it normal practice for insurance agents to monitor those policies and say, look, hey, this 20-year policy is going to expire next year. We need to do something with that.
If they were smart, well, okay.
Are they
Actually, no.
incentivized to do that? I guess
So
that's the
actually,
question.
no. So what's called, so when your term insurance comes up to that term, if you want to renew it, it goes into what's called ART, so annual renewable term.
Okay.
And so you got it when you were 20, but now you're renewing it at 40. Instead of your, 16 bucks a month, or, $100 a year, it's going to be more like $1,000 a month, or $2,000 a month, or
I
$3,000 a month.
gotcha.
And every year so it's guaranteed insurability. So they can't deny you, but you're going to have to pay. And every year it goes up and up
Can't
and up
deny
and up.
you, but I also can't deny that I'm going to charge your ass off for it.
And that's why a lot of these things don't pay out. So so
I
the
gotcha.
agent is actually incentivized from a monetary, okay, not as a moral standpoint, but as a monetary standpoint. If you continue to just renew at these huge premium payments, the agent gets more money
Yeah.
off of commissions of that. So technically, I guess no, it depends on again, it goes back
Yeah.
to doing your due diligence and finding out who
Yeah.
you're working with.
Yeah, and I need to do that. I have a term insurance policy now. Luckily, I several years ago I converted from. I did one of the dumbest things. I had my employer insure me, right? And
Mhm.
everybody's like, "Don't do that. If you have to, let's just say in 10 years you leave that employer, 10 now you're 10 years down the road, you may not be insurable 10 years down the road, and you kind of align yourself to that. So I went out and got a third party to do mine probably 5 or 6 years ago.
Man, that is a conversation that I would love. Oh my gosh, pensions, 401k plans,
Yeah.
group policy. I mean, health insurance, I would say is probably a big good benefit, but life insurance through your employer, 401ks through your employer, so many things. Oh my goodness,
Yeah.
so many things can go sideways that people. I mean, the vast majority doesn't happen to,
Yeah.
but it does
Yeah.
happen. It does happen a lot more than people want to think
Right.
about. So,
But
at
when
any
it
point
comes to insurance, you're not really, you're planning for the one off, right? You're planning
yeah.
for that exception to the rule,
Yeah,
right?
I mean,
For the most
in
part.
going, I mean, your employer tomorrow could just say, "Hey guys, we're going to cut costs. No more insurance for anybody." I mean, it's as simple as
Yeah.
that. I mean,
Yeah.
being in control of not only your money but just all the decisions that make up your financial situation. Man, if you can be your own bank, I actually had a conversation with Alexander Scott Felice after
Yeah.
your podcast.
Yeah.
He was like, "Yeah, you can just schedule a Skype call with me," and I was like, "If he's willing to do that, I'm going to do that."
Yeah.
So he said something that after, like a day later, I was chewing on it because I got into banking because that's where all the money is. And I thought to myself, that's true. So why aren't you making an effort to become your own bank then? If that's where all the money is, you can
Yeah.
become your own. So, um,
He's a self-proclaimed contrarian, so conversations with him are always interesting, right?
he's a man of integrity though. You
Yeah,
can tell
yeah, yeah. No,
he's not good. There's no BS. There's no BS with him. So
you definitely know where you stand with him. I enjoy our friendship, which is strictly through social media, and he's
yeah.
been on the podcast before too. But I appreciate his stance from where he gives me a hard time a lot, which I need. So um, let's talk about one other thing I wanted to ask you about there. So if I have let's just say I've kept that policy when I created when I was 21.
Mhm.
I know that was a mutual insurance policy just because of the name. I remember the name of the company, and I wanted to convert it. Let's just say, you call me up like you have been, or you've been active in the Facebook group talking about trying to help people with different strategies and whatnot along this infinite banking strategy um, option, right? Which again, a lot of people don't know, and I think it's I think you said it last time. It's one of those things that it's one of those tricks that the wealthy people know.
Yeah.
That it's just now.
Exactly.
I think because that was one of the qualifying questions last time. Hey, if this is so good, why aren't more people doing it?
Yeah.
And you
It's a
had a
secret
very
of the
good
money
answer to
masters.
that. Yeah.
It is a big secret. It's
Uh,
like you study game tape. If you're an athlete, you study
right.
game. One of my mentors, he is an avid learner, and he studies the ultra affluent. He studies institutional investors, and one of the things he's like, man, they're doing this all the time. I mean, they're doing this
Yeah.
crazy amounts. So why aren't more people doing it? It's just because it's not taught in school. It's not something that's really known by. It's not even taught in insurance agent training. You know what I mean? Like this isn't something that's normal. This is a
Wow.
highly specialized, you know,
Yeah.
avenue, if you
Which
will.
is, just to reiterate something we've said over and over and over, do your due diligence, right?
100%. 100%.
And I've always, I mean, this is obviously not the first time we've talked. It's not the second time we've talked, right?
Yeah.
And every time we've chatted, I've been impressed with your knowledge and information on the product. It seems you, if you're, and I'm using air quotes, selling me something here, you're very quick to answer with a confident answer, and that tells me that you know your stuff, right? So I don't think you're trying to sell me a bag of goods or a
Yeah.
bag of sticks or
I've,
whatever it's saying there.
that's the old adage, the jack of all trades is the master of none. I've
Yeah,
since getting involved with drive planning, I've really dedicated. I mean, part of the reason I'm not as active in real estate personally
yeah,
is because I've thrown myself at learning everything about this stuff.
yeah,
I mean, I want to be top of mind if someone's got questions about this. Hey, where's Anthony? Where's his number?
yeah, yeah,
That's I want to be a resource to people on this subject because I know how powerful it is.
yeah, yeah.
I mean, I've run so many numbers and scenarios, and I've used it personally, and oh man, it's really good stuff. So I
That's
want
also good to hear that you've used it personally, because
to.
it's
I'd
one of
be a
those
fool
things
not to.
where, yeah, yeah. I mean,
Yeah.
I'm sure you get that question when people are ready to sign up with you. One last
Every
question.
time, every time.
Do you use it? Do you use do you drink the Kool-Aid you're selling? So, but one of the things, I'll make sure I cover this. If I would have kept that policy when I was 21 until now, and it was a
Hmm.
whole life, wholer, I was going to say whole term, which is not what I meant to say. If it was a whole life with a mutual,
Hmm.
could I say, okay, now that I've had it with that company for 20 years, and if it was convertible, right?
Hmm.
Could I say, okay, now I want to take that sum of money and I will put it over into, give it to Anthony at Drive Planning, and let's create something through that. Is that what you were saying? That's a possibility if I would have done
Sure.
that?
So
Okay.
you're saying you had a whole life policy back in your early 20s.
Yes.
So it works just like a 1031 exchange where you take
That's the 1035 thing that you were talking about, right?
yeah. So
Okay.
insurance terms, it's I believe it's called a 1035. It's
Okay.
basically you just take the existing cash value in an existing whole life policy or an existing index universal life policy, and you use that to fund your you use it to fund your next policy.
Your next policy. Okay.
So an advantage of doing that, obviously, so the tax-free growth, if you then let the policy lapse, that money is withdrawn into your bank account. And so that
Yep.
is now taxable income. And so
Gotcha.
an advantage, hey, this is going to lapse. I'm not going to pay it. Or just, I want something more. I want something more powerful. You do that and it avoids the income tax on that cash value.
Okay.
Mhm.
Is there anything, like with retirement accounts, 401ks, you
Mhm.
reach a certain age, right now it's 59 and a half, then you can take that money out tax free. With insurance policies, is there an age number that which you can reach and you can get the cash value tax free?
So I would just qualify. I'm not a fan of qualified plans. I think we've talked
Okay.
about it a little bit too. So the term tax deferred, if anybody listening again has a tax deferred account, don't.
Okay. Yeah.
Tax
Convert it as
deferred.
soon as possible. Yeah.
Tax deferred just means I'm waiting to get taxed on my money. And right now, and this is a very not known fact, is a good time to get taxed. We're at the third lowest tax bracket in U.S. history right
Mm.
now, so it's a really good time to get taxed. So there's some different things that you can do depending on your age. So you can roll it out into a self-directed and then do another move called a 72T, which allows you to withdraw the money in large chunks, and you can use it to fund some of this. But to answer your question, sorry,
Yeah.
to
No,
answer
that's
your
fine.
question, so if the policy is structured correctly, at any point in time when you have access to the cash value, it can be collateralized via loan tax-free.
Okay.
Whenever you withdraw the money out, it is viewed as taxable income.
Okay.
I'm sorry. Let me rephrase. This is one of the only policies that you can do a first in, first out. Most policies are first in, last out. And what that means is if you do a regular investment, you're, let's say, $50,000 in, you make, say, $5,000 on that. When
Right.
you withdraw that and don't let it roll over, you have to withdraw the gain first so Uncle Sam can tax that via capital gains. This policy, you can, I guess, kind of compare it to a Roth where you
Okay.
have access to your cost basis. So as long as you're withdrawing your contributions or your principal, which is after tax money, it's not
Right.
taxable.
Okay.
So as soon as you have access to cash value, yeah, you can get to it tax free in some capacity.
Okay.
That's
Uh,
another advantage. It gives you early access and control. Like that is
okay.
so vitally important to this.
Yeah, because otherwise, yeah, that's a very um, good determining. What's the word I'm looking for? Um,
Differentiating factor.
Thank you. And I went to with determining, but I meant to say differentiate.
That's good, man. That's good.
Man, I appreciate it. Hey, so let's get into real high level how this thing works from
Yeah.
real estate acquisition, because I know we're running up on time. We got about 15 minutes. I want to make
Yeah.
sure we cover this very important part because as we talked last time, I hope you can see my light bulb is getting a little brighter, right? From last time. But last time we talked, we had you had provided the spreadsheet and this movie
Mhm.
video about here's how this works, and I'm like, well, it just looks like it appears out of thin air. So yeah, just poof, there it is.
Yeah.
So let's take for example, I have $100,000 cash value,
Sure.
and correct me if I'm not saying the right term, but $100,000 cash value. I want to use that $100,000 to purchase a property, whether it be buy and hold or a flip. I don't think it matters, right? As long
No,
as it
just
goes,
be a
okay,
car.
or a car,
Yeah.
okay.
Yeah.
As long as it's collateralized as a loan, as you put it
Yep.
earlier, then I
Mhm.
can take it out tax free and pretty much do what I want to with it. But in this case, we
100%.
want to buy more real estate, right?
Yeah.
So I'm taking that $100,000, I'm buying more real estate. Um, you got into something. I think this is where I got confused last time. That the value of that insurance policy would still stay at $100,000, and
No,
that's
that's the
where I
very,
got
very,
confused.
very big piece of it. Yeah.
Yeah, so that's another differentiate. I can't even say it again. Differentiate.
Everybody
Forget
knows what
it.
you're saying. Everybody knows what you're saying. Don't even worry about it.
uh, so help me understand. Try to help me understand that a little more this time.
Sure. So, okay. You have your $100,000 of cash value. Now,
Okay.
again, and I think this is nitty gritty
Not death
details.
benefit, but cash
Not death
value.
benefit, cash
Right.
value. And so the
Okay.
insurance company, again, depending on the insurance company, they will allow you to have access to 90 to 90 up to 95% of
Okay.
all cash value in there. So the reason they do that is because if you are going to borrow the money, it's going to cost you a small percentage.
Okay.
So they don't want you to leverage 100% because that means the policy is in jeopardy of lapsing or
Okay.
imploding. So
So now I have
let's just say
$90,000.
let's just say you have access to $100,000 of cash
Okay.
value, just for ease of
Yeah,
calculation.
I got you. Yeah.
Um, so you have $100,000 of cash value inside your life insurance policy, and you've identified a property. It's going to take for acquisition and rehab before tenants go in, before sale. It's going to be $100,000. What you do is you go in, you make a phone call, you send your email, you get the money wired to you.
And this is a phone call to you or
No,
somebody on
no,
your team.
this is. I mean, I guess technically, if you work with me, you can call me, and then I can call them. But I mean,
Okay.
I don't have to. I don't have to be a player. I mean, it's your money. I'm a consultant, not a.
Gotcha. No, I'm
I don't
following
like to
you.
touch your money. You know what I mean?
I'm following you. Okay. Yep. Very,
If I don't
very
have to be
important
involved, if
parts.
you want me to be involved, I can help out, but I don't
Yeah.
have to.
I got you.
He's not answering his phone. Dang it.
Yeah.
But so you got your cash value. If you go in there, they will then wire you the money into your bank account.
Okay.
Now, this money is used as collateral. Just like if you get a car loan, the car is collateral.
Okay.
Just like if you get a mortgage, the bank has a lien on your home. It's the same thing. That money stays intact at $100,000.
Okay.
They just put a hold on it. And
Okay.
so they have control. They have first say to it if you don't pay.
Okay.
The money comes from the insurance company, not out of your policy, but the insurance company's coffers. That's where that money comes from.
Okay.
Now you, as the investor, have that $100,000 cash in hand.
Okay.
Now, go ahead.
Yeah, I was going to say see, that's the benefit of doing this on video. You wouldn't have caught my facial expression to ask that question. So, um, when you say that the insurance policy has the first right to that money, you're talking about the insurance policy, not the property that I used to buy with that money, right?
100%. And
Okay.
that's another really good thing. This is a mutual company. It's private money. This
Okay.
isn't as a loan on your debt to credit score. This has nothing to do. So let's say you have while you're doing this whole deal with this property and you see another great deal, you can go to a bank or a hard money loan or a hard money lender and get them to lend you money to go do a second project at the same time this is going on, because
Gotcha.
it's viewed as a loan on your policy or on your balance sheet, because it's private money and it's already
Gotcha.
taken. You're not in debt at all.
Okay.
And they don't let you leverage it fully because they know it's going to cost you some. And let's talk about the interest rates again with a good company right now. I think the companies that we work with are 4.3 to 4.5% is going to be the
Okay.
cost of using that. So,
And why you mentioned that, so I let the W2 Capitalist Mastermind members know I was talking to you and the other
mhm.
podcasts that I've got lined up this week or interviews I've got lined up this week, see if they had any questions. And that was one of the questions that came from one of the members. When you borrow against your whole life policy, do you advise people to pay back the loan as interest only, lump sum, or an amortized schedule? I'm
Yeah,
gonna categorize amortized as differentiate,
there
because I
you
can't
go.
say those words this morning for some reason. But anyway,
That's all
so
right.
what do you advise people to do as far as the payback? I mean,
Yeah.
4.3 is pretty inexpensive, but
Yeah. So that's another beautiful thing. There's unstructured loan. So you're guaranteed, if you have the cash value, you're guaranteed to get the loan. They can't tell you no. That money is
okay,
your money. So you're guaranteed a loan. Two, there's unstructured loan repayments. And so let's say if that property doesn't cash flow like you were projecting in the
yeah,
year's time frame,
yeah,
you don't have to pay that money back as long as you have enough cash value in your account to cover that 4% interest.
okay,
So again, let's go here. So you're doing your thing over here with real estate. Your $100,000 is, let's just say, that take the average of 5%. So
yeah,
passively, this $100,000 is going to make 5% tax free. That's going to be what, $5,000, right?
sure, yep,
Yeah. So $5,000 of internal growth. How much is the money costing you to use?
4.3,
4.5%.
yeah,
So your internal growth in this $100,000 has covered the cost of using this money out here.
gotcha,
And so your policy's growth, again, they're going to put a lien on that percentage. So you're really netting a 0.5% inside your policy to collateralize more. But your policy is funding itself, if that
yeah,
makes sense. And so now you're out here, and again, if you're doing your job right and you're doing a
yeah,
good, you have your $100,000 in two places at one time doing multiple jobs. And so this property is not only appreciating, but hopefully it's cash flowing for you if you're buying holding it. And then from that point, you can make small payments. And that's where a lot of power comes from this. If you have cash flow, what do you use your cash flow for? Is it
yeah,
make you live better? Most of the times, no. I mean, if you're an earn, invest, and repeater, you're putting that
right.
money back into your accounts and you're saving up for your next deal.
I appreciate the plug on
Yeah, of
the
course.
mantra.
Of course.
That was good. You
So
did. That was a good transition to it too.
let's just say you take all of your cash flow and you put it back into the policy. Again, you're paying interest. So you can do interest only, because again, if you structure this through your business, through you, and that loan is through a business purposes, it can be a tax deduction for you because it's a business expense. So the interest can be a business expense. So you're getting that good tax deduction. So if that's all you can pay or that's all you want to pay,
Yeah,
you get a little tax break on there. But as you pay it back, let's say you put some to interest and you put some to principal, you decide what amount goes to what to. Again, it's your money. You're in control
right.
the entire time here. But let's just say you just put $500 back into it, boom, 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 time and time again. What that's doing is it's lowering the lien on your money
Yeah,
over time. And so you're not only getting internal growth, but you're also paying for the policy, which is increasing the amount you have to collateralize. Then it's also reducing the lien on it. And so let's say a few years down the line, you now have $75,000 in there, and you go use that for another project, and now you
okay,
have two projects going at the same time, and it just churns and churns and churns.
yeah.
And obviously the more in there, the the more that's in there, the more you can do. But
Yeah, yeah. So let's talk about that and let's get morbid for a minute. So
yeah.
let's just say I have $1 million available to me, right,
Okay.
from my policy. I go out and I buy 10, and some people are going to cringe at this, but let's just say I go out and buy 10 single family homes at
Sure.
$100,000 each, right?
Sure.
And then I die.
Hmm.
What happens?
Sure. So
I mean, and those $100,000 would secure loans for these
mhm,
properties, right?
right.
So now the 10 properties, have mortgages on them.
Hmm.
I'm no
Well, not
longer,
technically. You are your own mortgage lender. You owe that money back to your cash value.
Okay. Well, let me ask you this. Let's just say I have $100,000. We'll get back to that question here in a minute. Let's just say I have $100,000 available. I want to go out and buy a $500,000 property. Can I
Okay.
use that $100,000 as a down payment on a $500,000 property?
Absolutely.
Okay.
Mm-hmm.
So let's just say I did that
That would be a smart move. Yeah.
10 times, right?
Okay.
Yeah. I'm using that a million bucks.
Mm-hmm.
Now I have $5 million, roughly $4 million of mortgage payments or mortgages that have to go into. I pass away, right?
Mm-hmm.
The family throws a big party. Hey, he's going.
Yeah.
I'm joking. My wife is probably going to beat me up if she listens to this one. But what happens to that? What happens to the policy? What happens to the mortgages? Like what, there's a lot of numbers that kind of move around on that event, right? In this case, it's my death. What happens in that scenario?
Sure. So,
and then we'll wrap it up. Okay.
You have a lien. Obviously, you have a lien on that quote unquote down payment from your cash value, and now you have mortgages on those properties as well. You're a buy and hold guy, so I'm assuming from a buy and hold perspective. Ideally, they're cash flowing too, so they're curbing the feel, curbing the pain of the mortgages, right?
Yeah.
So as long as they're cash flowing and they're covering the mortgages, that's good. But here's what's great is you still have a death benefit.
Okay.
So when you pass away, the cash value then takes care of that down payment. Now your mortgage is still there. Now, if you had $1 million of cash value, chances are you have a pretty good sizable death benefit as well.
Yeah.
There's ways to, again, the death benefit appreciates along with you. You age like a fine wine, so does your death benefit. Fine bottom shelf whiskey. I don't know. Military special.
Nice.
So your death benefit is there too. So your death benefit then goes to your beneficiary tax free. And let's just say you said $4 million in death in outstanding mortgage.
Yep.
So your family can either take that to pay back those mortgages, but if they're cash flowing, they're already going to, have floating, or so they can accelerate the down, paying off of it, use some of it to pay it off, or use some of it, to live, obviously. So that's again, that I would encourage people, if you're going to leverage highly like that and go really aggressive and have that much, again, being in debt and having debt is two different things, but if you're going to carry that much debt professionally, make sure your death benefit's there to take care of your family just in case something happens. So you can leverage up your cash value, but again, your cash value is still separate from your death benefit. So if you have a $1 million cash value account, chances are you're going to have anywhere from $2 to $5 million in death benefit, maybe more. Maybe more. And so that would go and cover all the mortgages. And now your family owns those properties outright. They can either sell them off or keep holding them.
Yeah. And that's one thing I don't like about our current insurance policy is that it doesn't do a whole lot for, it doesn't do a whole lot for the family once I'm gone. That's something that I've got to focus on.
Of course. I mean, and that's, no one likes to have that conversation, but every job has its hard piece, and that's a big piece of it. I mean, you can't, I get this term like, well, my life insurance policy is my properties. Yeah, that's exactly what I want my wife to deal with after I'm gone. I want her to become.
I'd rather there be enough cash flow in those properties so that the property manager takes care of them.
And again, I hope they have a property manager in place too. So.
Yeah, they do. We do on all of ours. So it was a struggle to find the right ones, but once you find 100%, them,
exactly. That human capital is vitally important.
Yeah, it is.
Hey, a quick plug too. We talked about young kids.
Yeah.
I mean, it is so incredibly easy to do this. For college planning purposes.
Yeah.
Your kids will graduate college with a positive net worth because they can literally collateralize college. I mean, it is a masterful play. It's an absolute play.
Well, I wrote down a potential title for this episode is "Use Your Kids to Leverage Your Infinite Banking Strategy." I don't know how.
No, the cost is so low. I mean, you would have to. Your kids are going to be a $10 million death benefit to put a lot in there, but you never know.
You never know. I mean, it's an option.
Right? There's the insured and the owner. So you as the owner, you pay for it, so you control the money. So
well, Anthony, I know we're coming up on time, and I appreciate you having this conversation with me again. I think, of course, man, you've seen the light bulb get brighter and brighter, and I'm now grasping it. sometime, we've got a couple of things going on. I'm actually changing W-2 jobs.
Hey, congrats, man. I think congratulations.
Hey, oh
Yeah.
yeah, it's
Yeah, good.
I wasn't forced. I don't. Maybe I was forced. Uh, but it's an excellent opportunity, potentially to earn more money.
Yeah, man. Congratulations.
And then it'll be a good growing opportunity for my family. But so that's coming up within about a week and a half is when I'll do that. And then about 2-3 weeks after that, we've got baby number 3 should be here by then. We've got a lot of life-changing events coming up, but after kind of the dust settles, I want to circle up with you personally and
Yeah,
start talking more about this
of course.
and do something,
Yeah, man.
but I think the one
Hey,
thing
take
that,
your 401k with you. A lot of people don't. That money's yours. Roll that thing out. If you have existing 401k money
okay,
with W-2, get it into a self-directed. You can start putting
yeah,
it towards
yeah,
real estate.
yeah, yeah. I've got 2 properties under
Okay.
SDRA, that was one of the things when I saw, I was like, hey, that was on the pros column of leaving is to take that 401k and put it in the SDRA.
Yeah.
The only thing I don't like about that is you can't get that money tax free until you're 9.5.
I hate it. I mean, if it's a true IRA, it's locked in until you're an old person. And I'm a fan of being able to live now.
Yeah, yeah.
Shouldn't shouldn't not live. And that's again, Dave Ramsey teaches really good stuff, but he teaches a really hard life until you're an
Yeah,
older person.
yeah.
And we're not guaranteed tomorrow. As much
Correct.
as we think we are invincible, we are not guaranteed
We
tomorrow.
are
So
not. Yeah,
structured your money some way to live today so you don't have to sacrifice tomorrow. That's the way to do it. So
yeah,
it's
yeah.
one of the this is what the infinite banking concept, the private reserve strategy allows you to do. So,
I gotcha. Yep. And now on the 401k, I do the match minimum. That's it.
yeah.
It's kind
I
of
mean,
hard to
even with
turn down free money.
I get eviscerated online every time I talk about this. Is the match even really worth it? You talk about market fluctuations. I mean,
I know. Yeah.
uninterrupted compounding interest, which is what this whole concept allows you to have. If the market down 6 months ago, the S&P 500 took a landslide. It took 6 months to recover
Come
from.
back.
Now, hey, it recovered. My account's looking great. Well, you're also contributing to
You're
that account.
breaking even.
If you leave that business, and it happened to me too. I didn't meet the vested period with my last job, and so
Yeah.
I thought I had 10 grand in there. I had four. I had $4,000. I
Of
was
your own
livid.
money. No man.
Yeah.
Yeah.
Oh man, it was crazy. It was crazy, and so
Yeah.
it's, in my opinion, there's a better right now with the taxability codes being so low. It's just a good time. Just have that money in
And
your
jump in.
control somewhere. So,
Yeah.
and don't let it die in a bank. So,
If we've established one thing today, I think you'll agree is that all infinite banking strategies or mutual insurance policies are not created equal, right?
that is very true. It is
Okay,
very true.
cool.
If because every insurance agent knows how to write a permanent insurance policy, and I connect with a lot of insurance agents, and I've conducted training even to small organizations to show them how to actually use it. Um,
Yeah,
every agent can write these policies, but they don't necessarily understand the implementation of it. It's a
yeah.
product to them. It's not a strategy. So,
And there's a big difference. I love that. It's not a product to them, or it's a product to them. It's not a strategy. I love
exactly.
that. Well, Anthony, thank you again for your time this morning.
Yeah,
I hope
man.
the family gets to feeling better
Thanks.
very
Yeah, I
soon.
appreciate it. I think we're all on the up and up. Yeah.
Good, good. Tell us what's the best way if somebody wants to get in touch with you.
Yeah, I try to be extremely available. So I'm going to throw my number out there.
Okay.
So it's area code 904-707-3114. Feel free. I'm not going to answer if you call me, so shoot me a text first, and we'll set up a time to talk. Email address is my name separated by a period, so it's anthony.ornella@driveplanning.com. And again, obviously, you can find more about drive planning at driveplanning.com. We offer a bunch of different solutions and strategies from the financial aspect of it. So,
Yeah.
people are very scared to get into real estate, and if you structure your stuff correctly, I mean, people are losing money way more than they know.
Yeah.
And so finding and capturing lost capital, it's not through a budget. It's just people are very cash flow inefficient today. So
Yeah.
we help people find their hidden cash flow and then redirect it into stuff like real estate. So,
Awesome. I'm looking forward to personally engaging with you on that.
thanks,
So
man. It means a lot to me.
maybe June,
Yeah, that's good.
July.
So my wife's in the reserves now, and we go back to Hawaii 1 month out of the year. So
Okay.
to, I think mid-June to mid-July we're going to be at Joint Base Pearl Harbor Hickam. It's a hard life.
Nice.
It's a
Yeah.
hard life. It's a hard life.
It sounds like it.
But Jay, I really thank you, man.
Yeah.
I've been a part of your Facebook community, and I'm really honored to be on the podcast, man. You
Yeah.
are a coach and a great asset for a bunch of people.
I
So
appreciate
thank you
that.
so much, man.
You're welcome. There was a guy who posted this last night or this morning talking about, hey, if there's one thing I've learned from this group is that you need an accountability partner, and I need one to stop spending so much money on random stuff. And I'm like, that's not even part of our message, but he got that. That's awesome.
Yeah.
And
Yeah.
anyway, but thank you for engaging. I
Of
mean,
course.
that group has outgrown my expectations, and now it's like, okay, let's get serious about it,
Yeah.
and
Yeah.
see where we can take it. But thank you for that, and I will let you know. This will be a few weeks coming out. What
Yeah.
I'm trying to do, I'm trying to ramp up these interviews. I've got several this week,
Mhm.
so that when the baby gets here, I don't have to worry about
Yeah. Smart. Very, very
pushing them
smart.
out. So I've got a bunch of stuff lined up. So I'll let you know in my, I'm sure, sleep deprived mind when that happens, when it comes out. Okay.
Sure. Yeah.
Thanks again for your time, man. Hope family gets feeling better very soon. And I'm sure we'll chat very soon. Okay.
Yeah. Cheers, Jay. Thanks,
All
man.
right, buddy.
Appreciate it.
Have a great day.
Take care. You too.
Bye.